Hello, this is Guan Invest. Today I'll be talking about whether or not the Singapore bank stocks are still a buy right now. So for Singapore banks, they have primarily a few ways that they make money. So one of it is called net interest income, where they make basically the difference between the US yield and the loans that they lend out. So the higher the interest rate, the more net interest income they can make. And so when interest rates are high, these banks normally they make a lot more money. And that's why we're seeing a resurgence of all these banks, meaning to say in the past year or so, most of these banks, if you're OCBC or UOB or DBS, almost all of them went up around 30 to 50%, and it is at a historical high in terms of their price to book right now. So is it time for you to invest into all these different banks in Singapore? So for me at least, I'm holding off all these banks, although the banks are very well managed. So like DBS, they only have a 65% payout ratio if I'm not wrong. And then you have OCBC, relatively low payout ratio as well. Although all these banks, they are very well managed in terms of their financials, I don't think buying them now is a very good time for you to add. So there are a few reasons why I say we shouldn't be adding the banks now. So first one, most important one is the interest rate environment. So consensus is now saying that the interest rates will slowly come down. I mean, if they increase interest rates from this point, right, then the stock market, everything will start crashing already. So consensus is that the interest rate will start gliding downwards. We don't know how long it will take for it to start coming down, but it will come down. And so when the interest rates start to drop, all these banks, they will lose a lot of their earnings. So DBS, for example, I calculated, they said they will lose, if I'm not wrong, around $10 million per basis point in terms of their earnings. And so the decline in earnings for DBS will be between 3 and I think 9% if interest rate were to go back to 3% from its current stage. And I expect OCBC and UOB to be a lot more than just 3 to 9% because they're not as well managed as DBS. So that's one thing, the macroeconomic environment. The other one is simply just valuation. So if you look at all these bank stocks now, you have DBS trading at around a 1.9 price to book. You have OCBC trading at a 1.4 price to book. All these price to books are at a historical high. So yes, Singaporean banks, they are very high quality in relation to all the other banks in the world. But I don't think paying a 1.9 price to book like the US banks like Goldman Sachs, JP Morgan is very advisable right now. Because if you pay a high valuation right now, if the earnings start to drop and the multiple contract at the same time, right, then you see a double whammy, meaning your multiple contract and then your earnings contract at the same time, and then your stock price will drop even more. So for Singapore banks, I don't think it is a good time for you to add into them right now. Next stock that I'll be talking about is Wilmar. So Wilmar is a commodity stock. They sell all the different commodity products like your oil in Malaysia and all that. And I looked at their earnings recently, and they dropped their net profits by I think around 40% or so year on year based on the quarter. So for me, I think Wilmar, based on my valuation, I don't think it is extremely expensive. But the problem with owning a commodity stock is the company cannot control commodity prices, meaning to say they have no competitive advantage. All they have is just they will sell oil. So if you go to like let's say a supermarket, what is stopping you from choosing one oil from another? It's just price. So all these commodity companies, the only competitive advantage that they have is just pricing their products lower than others, and that is not a very strong competitive advantage. So even though I think Wilmar now is currently at a quite cheap valuation, it is an easy 7% from here, maybe for the next 5 years or so, but I wouldn't be buying it personally. Next Singapore stock is SETS. So SETS is a catering business. They do all the different catering things. They have their own like cookhouse and all that as well. So for SETS, the problem with the business, right, is the poor management. So I look back at their management history, and I think back in 2022, they raised debt to acquire another business. And now the debt to EBITDA, which is the debt to the earnings before interest, debt, depreciation and amortization, is around 11 times. That is more leverage than a lot of the REITs in Singapore, and it's just crazy. So for SETS, because of the high leverage, I will stay out of it, meaning to say I won't be touching it. Because if interest rates were to rise by just half a basis point, right, SETS earnings will be hit very badly because they have so much interest loans to pay. Next stock is SGX. This is one that I'm currently a bit interested in. So SGX, they have a few business models. They sell, I think, indices or something like that. So they do futures, they sell options, they collect fees and all that, and then they have their own listing website as well and all that. So SGX is basically a monopoly in Singapore when it comes to the stock market. So we have seen recently that Lawrence Wong is trying to push more Singaporeans towards investing in the Singapore stock market. And so SGX will definitely benefit from it because it's a monopoly in Singapore. So we could be seeing this secular growth trend where more Singaporeans invest in Singaporean stocks, and that will just help SGX bottom line. So it is one that I'm currently interested in right now. I'm still sort of like reading up on the stock, but it is not cheap enough yet. So it's currently trading at around a 22 to 24 PE. I think that is slightly overvalued for a Singaporean stock. Maybe when it comes back down to a sub 20 PE, then I will consider it heavily. But based on all the metrics, all the fundamentals, I think it's great.